Welcome back to Outlook 2023. We now have the top guns from Citi India, Chief Economist Samiran Chakraborty and their Head of Equity Research, Surendra Goyal. Guys, welcome. Samiran, let me start with you. I read a large part of your report. 5.9 is the forecast. What will be the main themes that govern your growth? 5.9 doesn't look like a particularly bright outlook.
We have to be very conscious that there are headwinds. There are headwinds from interest rate hikes in India, which will have a lagged impact. Global slowdown would have an impact through net exports, and there is a base effect. But having said that, I think Indian economy has shown a lot of resilience on the growth side, and we are taking that resilience into next year as well. One of the themes that we are working with is that rural demand might do better than urban demand next year. One of the key risks that we are highlighting is that the excess savings of the pandemic is almost coming to an end. So that might impact urban demand. Whereas if we look at rural demand, then both on the agricultural side, where the winter cropping has been very good, and on the non-agricultural side, where we have seen a very sharp pickup in construction jobs, create the right backdrop for some improvement next year. And we expect public capex to continue, and we are probably somewhat more hopeful on the private capex side than some of the peers are. That's why probably we are closer to 6% on our GDP growth forecast, whereas some people might be looking at an even lower number.
Yes, I've heard 5.5 on the street. Just one more question before I come to Surendra. It's a pre-election year. So does that mean something positive for rural households, which has a bearing on the stocks he will speak about?
Right. So that's quite a possibility, and markets will obviously be thinking about it. The only thing I would somewhat caution is that since we are looking for some consolidation in the fiscal deficit, I don't see that consolidation coming either from higher revenues or from lowering of capex. So what we are looking for is more a reorganization of the rural spending in some sense, because we think that about 0.6% of GDP compression could happen on fertilizer and food subsidy just because prices are lower and the fact that the free food scheme might not be extended. So that lowering of subsidy could be reorganized towards something else on the rural side. But I don't see that the government will not do any fiscal consolidation and go in for an all-out rural spending.
They won't do. Okay, so Surendra, it would be tempting to start with IT and global, but I'm going to start with domestic. What is the consumption theme? Do you play stables, discretionary, autos, what?
Yeah, so kind of following up from what Samiran was talking about, we think that on the urban side, there is a base effect, okay, which kind of gets a bit more challenging as we go into calendar 23. There was a benefit of reopening. There was a benefit of formal jobs being very strong, partly led by IT. All of those things are kind of at the margin slowing down, and there is a base effect, right? So that combination is not really that good for urban. While on the rural side, it's been weak for some time. And because of the things that Samiran spoke about, we think that if some of those things come into play, there should be an improvement on a base which is not really strong.
Yes.
Okay. So in that
context, what about the level consumption, FMCG types?
Yeah, so we have actually raised staples to neutral, not overweight yet, but we have raised it to neutral for the first time in a while. Okay, so that's one change. While on the discretionary side, we are still underweight.
Underweight.
So that's the positioning.
So you will not be very bullish on autos?
So autos, we are still overweight. Okay. Having said that, I think one needs to be a bit cautious because like obviously the stocks have done well. And some of these segments, you could see things slow down a bit. But the reason we are overweight is, for example, there are plays which are leveraged to the pickup on investment side. So right now, we have changed our preference towards some of those stocks in line with what Samiran was saying again. So we have made those changes, but autos, it's still an overweight for us. Other discretionary ex-autos is an underweight, while staples is a neutral.
Okay, I'll come back to this capex cycle thing. But before that, since external is so important, Samiran, do we still battle the rupee? The November trade deficit was distinctly lower than October. So do we still go for an 83, 84 on the rupee?
So the thing is that the external environment on the current account side would look much better next year. we are looking for an FY24 current account deficit lower than 2.5%, maybe closer to 2%.
Okay.
But we are somewhat more worried on the capital flow front, because if global central bankers are tightening liquidity, that could have an impact on capital flows. So net-net, we have a somewhat of a flattish BOP picture for next year, which is a big improvement from this year.
Yes.
But the bigger story to us is that our global strategists think that the dollar will weaken in 2023, looking at 1.15 on euro by December 2023.
Then flows should come, no, to EM?
To some extent, yes, but ultimately it will also be a function of global dollar liquidity. Okay. So if I take that view, then we are looking at rupee to come down towards 79.80 by end of the year, tracking somewhat the global dollar movement, because already in the current move, the 40-country RER is already coming very close to the lower band where RBI has been typically comfortable with.
Okay. Well, the screen is screaming out your year-end projection. So let me come to that first. Surendra, what are the earnings forecasts for FY24? And of course, you have to give me a 23 as well, and then 24. And therefore, what's the gain for the Nifty?
Yeah, sure. So we have a 13% growth for this year and then 14% next year.
Nifty EPS.
Yeah, Nifty EPS. It's again slightly below consensus, not really a very big difference. Having said that, on valuations, we are starting at a fairly high point, right? Currently, the market rates at 20 times 1 year forward. And if you look at on a relative basis, relative to EM, relative to yields, whichever way you look at it, it is on the higher side in the context of where it has traded. So we do expect that multiple tapers off a little bit, and that's how you get the target which we have put out, which essentially doesn't imply a lot of upside from it.
Okay. Samiran already referred to global slowdown because of the tightening central bankers. Where does that leave IT? It's really fallen. So is all that bad news in the price? Where are you on those stocks?
No, absolutely. So we have been getting a lot of questions because it's underperformed 30% so far this year versus the market. See, in IT, if I go back over the years, the variable which has really driven the valuation multiples is growth. Okay, and till the time you can get some certainty on growth outlook, or valuations really go to a point where you can say, okay, valuations are so cheap that I am ready to take that leap of faith. It's a great sector medium term, right? So right now we are neither here or there on either of those parameters. Okay. And that's the reason we are still, so we have been cautious for a year and a half. We are still cautious for now. And again, kind of just reminding people who keep talking about the 30% outperformance, yes, that even today, the sector trades at 22 times 1 year forward. Pre-COVID, 3-year average was 18 times. So it's not really cheap in that. The underperformance is kind of too much front and center. Okay, but valuations are not really cheap.
Yeah, and they were falling from real highs, and that's why
so
perhaps.
In fact, I was telling a client yesterday that if you look at the performance since Jan 1st of 2020, IT has still outperformed quite nicely. So we had a massive re-rating. We went to 32, 33 times earnings. Yes. So
take your point. So even at 22, who is to say it won't fall to 18? Samiran, the capex cycle. We're seeing very good credit growth numbers. So is that something you would bet on?
So clearly, a lot of the preconditions for a capex recovery are in place, whether it is the balance sheet of the corporates or whether it is the balance sheet of the financial system. If you look at the asset turns of corporates, that's showing that capacity utilization levels in certain sectors are really high. So that makes me somewhat more optimistic on the capex cycle, and at least our analysis suggests that the headwinds from interest rate hikes are not as big as some people make it out to be. And that's why we are looking at around a 7% investment growth in real sense for FY24, which is ballpark a good number. 6 to 8% investment growth is a pretty good number, but we could potentially go to 8 to 10 also if the global situation is more favorable. That's the only condition which is not being met. So all the global focused companies might not be doing enough capex this year, and that could be a little bit of a drag. But otherwise, I think most of the private capex preconditions are in place.
Conditions are in place. I'm yet to see that flood of announcements of expansions. I mean, we see more of people buying each other's companies, but I've yet to come across large announcements of expansions. Therefore, Surinder, which stocks? I mean, would you go with the L&Ts, people who will benefit from construction, or do you, how do you play this capex theme?
So we are going with stocks which benefit from construction. So we are overweight on that segment. If you see our overweight list, it appears right up there. Because we think the conditions are right, as Samiran spoke about. And even the capex intentions, when you look at some of the data around that, it appears to be highest in a long, long time. So everything seems to be falling in place except the global backdrop, which again Samiran alluded to. But it definitely feels like it's one of those spaces where the outlook will be better in the next 12 months than it has been for a long time. Okay. So we are essentially, our overweights, a lot of them are around spaces where either visibility is better than what we have seen, or there is growth and the momentum is going to sustain.
Okay, so just to come back to the big question that, investors will want to know, your base case of Nifty is only 18,300. So basically, a passive fund guy is not going anywhere. You will have to be an alpha manager, an active manager.
Absolutely. So I think, which is the reason if you see our overweight, underweight list, pretty much equal number of sectors on both sides. Because we think it's going to be that kind of a market. Even if you look at this year, it's not like been a huge return year, right? India has done better relatively, absolutely. But it's not been a big return year. But there are sectors like banks have had a great year, right? So there are sectors which have done very well and there are sectors which have not done well. To me, it looks like the same story could continue, given that the starting point on valuations is already on the higher side.
Okay. Well, it's like a glass half full. If you choose the right stocks, then you perhaps will not say that it's going to be a static market for you next year. Choose the stocks that you heard Surendra's arguments. The economy only 5.9% next year, but that would still make it one of the fastest growing economies. Thank you very much for watching this special edition of Outlook 22-23.